Hello, I'm Campbell Harvey, and I'm going to do a LinkedIn Live for Fuqua today. And I'm really excited to talk about decentralized finance and Web3. And most of what I'll talk about is Web3. So, obviously, crypto has been in the news a lot. Prices are down sharply, which actually we've seen before. This is kind of like the number six time you see a very large drawdown. And that's not unexpected given the high volatility of these new assets. But other things are in the news, like FTX, and the exchange goes bankrupt. The hedge fund associated with it is bankrupt. Many crypto lenders bankrupt, and many people ask the question, well, you work in decentralized finance, and this must be damaging. I recently published a book called DeFi and the Future of Finance. I got an email from a colleague saying, well, you're going to have to revise your book given what happened to the stock exchange or crypto exchange, FTX. Well, this type of question shows that maybe people don't fully understand the difference between decentralized finance and centralized finance. So FTX is a centralized exchange. So just like any centralized exchange, you buy some stock. Let's say you call your broker, you want some stock. The broker essentially holds that stock for you, but holds it in their name. It's not in your name. You can always request the stock go into your name, but the usual practice is that it's custodied by the broker and they hold it. And with FTX, the same story. You send some money to FTX, they buy some crypto. Crypto is defined by a private key or a password. Well, you don't actually have that. You delegate to FTX, and FTX holds the private key. And if FTX goes bankrupt, then you're just another creditor. Okay, it's the same thing with a centralized exchange. If they go bankrupt, then a stock exchange, then you're just another creditor. There's some insurance programs for that. But I want to emphasize the difference between this and decentralized finance. So in decentralized finance, it's a peer-to-peer mechanism, and any exchange is moderated by an algorithm in a blockchain called a smart contract. So if I want to buy asset A, I've got asset B, then I send asset B to the smart contract, which exists in a blockchain construct. This contract is totally open source. You can see the liquidity, you see the price, you can trade whatever time of the day, whatever day of the week, it doesn't matter. So I send asset B, I get asset A. Okay, so I sign over my asset B and I get asset A. And the execution of the trade and the actual settlement of the trade is simultaneous. And that's hugely different from centralized finance, where we've got many layers of middle people. So decentralized finance is all about taking out the middle layer and transacting directly with people in a peer-to-peer way. And there are many advantages to doing this. It obviously can vastly decrease transactions costs if you're not paying for all of this middle layer. It's very efficient. It is very inclusive. So in a peer-to-peer network, everybody is a peer. There's no customer and banker or institutional investor or retail investor. Everybody's the same. So this is a technology of financial democracy, of inclusion. It's highly secure and highly disruptive because it actually, what it does is it's a different approach to our financial system. And you can have different approaches that use the current infrastructure, and fintech is a good example of that. And fintech is great. It reduces transactions costs also, but there's a limit. as to how much you can reduce those costs because you're using this legacy infrastructure of the banking system. So, um, so this, I think, is an idea that will benefit from some of these recent scandals because it really sharpens the distinction between a centralized exchange, for example, and a decentralized exchange. So, with the decentralized exchange, it's just a very quick transaction. It's not like your money is being commingled with a hedge fund or anything like that. So it's just a direct transaction. So decentralized finance is important for another very important innovation, and that's Web3. So I've been talking about Web3 before it was called Web3. And what I was calling it was the Internet of Value. And let's kind of go through Web 1, Web 2, and Web 3, and you can see sort of the progression. And I apologize to my students because we just talked about this yesterday in my class. But I want to have, obviously, a broader audience for this. So it was very interesting at the beginning of the World Wide Web that the developers just assumed we would have the ability to digitally transact, so have a digital currency. And there was a robust research program in the 1980s proposing digital currencies. So they just assumed that was going to happen. And indeed, some functionality was built into the early browsers, just assuming that the switch would be turned down for digital currency. But all of these digital currency initiatives failed. And they failed for a very simple reason. Just like you can make a perfect copy of a digital image or an audio file or a video file, you can make a perfect copy of a currency. That's not going to work. So all of these initiatives failed until an idea was proposed in 2008 by Satoshi Nakamoto. And the idea basically created a digital currency that you couldn't spend more than once, or you couldn't make a perfect copy of. Okay, so that's the setting that the World Wide Web launched without this functionality. And Web 1 was basically push information. So instead of getting a paper version of the New York Times, you could view it online. And it was a replica, effectively, and that was convenient. So Web 2 is more social. So we get the growth of social media, and an important part of that is that users actually contribute content. So users upload, for example, a video, and people look at that, they like it, and there's a community around that. So one issue is the business model. So you can think of these companies in the social media space. They essentially are selling your data to advertisers, and the advertisers are pushing the advertisements on you, and the advertisers are paying the social media platform, and you don't get anything. And that's the way that Web 2 works. So Web 3 is different because it incorporates a payment mechanism, and that is decentralized finance. So to be clear, there's no Web 3 without decentralized finance. Okay, so it's interesting to me. All of the focus is on FTX and Sam Bankman-Fried or Elon Musk tweeting about Dogecoin. And under the radar screen is a disruption that I think is vast. And it has to do with not Dogecoin or Bitcoin, but the implications for many businesses that exist today. And that's where I want to go in terms of Web3. So if we think about Web3, it's got a payment mechanism. So that means you can be paid or be paid. That payment mechanism is not the mechanism that we got in Web 2, which is very clunky. So load your credit card in, or worse, put your bank account information in. So people really don't want to do that because it's been proven to be insecure multiple times. In addition, you can't do really small transactions. So to go through and load your credit card information for like a 1 cent transaction, that's just not going to work. Okay, so Web3 has got this functionality with decentralized finance. And let me basically sketch the sort of implications. So let me go through a few examples of what Web3 could bring. So I often start my class with a simple example, which is ticketing for a concert. And in this space, you've got very powerful companies, and you might call them monopoly, duopoly, but the implications are really clear. You buy the ticket for the concert, and 40% goes to the company, okay, that sells the tickets. Not the artist, not the venue. So 40% haircut. But they also do something else. So these companies create a wedge between the artist and the fan. The fan has a relationship with the ticket company, not the artist. So this is an ideal application of, in crypto, we call it NFTs, or non-fungible tokens. Non-fungible tokens are unique. And a ticket for a concert on a particular date and a particular seat is unique. So think about the model where the ticket is now an NFT. So obviously you solve the 40% problem. You also, this is kind of interesting, you can build into the NFT functionality that if the ticket's resold, then the artist gets a royalty, let's say 10% on any resale. So that kind of works. And it might be that the ticket gets you discounts, the NFT gets you discounts on certain things. But importantly, you create a community. So the artist can interact directly with the fans. The artist can tell the fans when the next concert is. The artist might airdrop a new song for the people in this community. So directly connects the artist with the fans. And all of this is just a straight up application of crypto. So this isn't Web3 yet, but there is a Web3 angle to this. Now suppose we change it a little bit, and the first 1,000 people to buy tickets to the concert also get ownership in the concert. So if the concert does well, it's sold out, then they get a payoff. Okay, so this is really important for Web3, that when you interact with Web3, you're actually also making an investment. So now basically you're not just getting the ticket to the concert, you're participating in the success of the concert. And that changes your behavior. So you're more likely to promote the concert to your friends on social media because you're an investor. Okay, so this idea is a very powerful idea. So let me go to some other applications. That was a very simple application, but I want to do a very quick tour of some other applications. So social media in general. So again, it's a bad business model. It's not sustainable. What's happening today? Your data's sold, and basically you don't participate. So in the future with Web3, what it's going to look like is that you choose to share your data, or you choose to have an ad served to you. And then when you choose, then you're paid for it. So instead of the advertiser paying the social media platform, they pay you directly in the platform token. Okay, and you can take that token and sell it for US dollars. But there's a market for it because the advertiser needs to buy it. So you're connected directly. So this will fundamentally impact all of the social media platforms where the consumer or the user is going to be directly attached to the advertisers or the companies directly using that platform token. This applies for search engines also. Again, search engines effectively, they're advertising models that collect your data, and you do a search and stuff is served to you, and they get money out of that. That will change also. But the ideas here go well beyond just social media. So one application could be, and all of these applications are live applications. So Wi-Fi is another one where you create your own network. People invest in, let's say, a 5G radio. They're part of the network. They get paid if people use the radio, and the users actually pay, all in the platform token. So again, you create two sides of the market for these tokens. But there's more things that can be decentralized. For example, video streaming. So again, you can participate, and everything is moderated with a platform token. Music streaming can be decentralized. There are 80 million subscribers to streaming services in the US, and this is a market where you've got a middle person, and it's very hard to make money as an artist on this. And in a decentralized system, it's a lot easier. There's also decentralized video streaming, so as an alternative to what we're doing today. And think of decentralized computing. And one way that's very intuitive to think about this is think about all of the CPU that's not used. Like, how much CPU do you use on your machine every day? Like an hour? 2 hours? Why not rent that out and get paid for it? So again, you get paid in a platform token, and those that want to do computing, well, they need to buy that platform token. So you have both sides of the market. And as for valuation is remarkably simple because you've got a comparable in terms of the cost of doing computing by the existing centralized providers. And this also goes for things like storage. So disk storage, you've got an extra terabyte. Why not rent it out or rent out half of it and get paid for it? So again, you've got this two-sided, the economics is very sound. You've got a two-sided market, and you've got people that demand the token and people that get paid in the token, and they can sell it if they want, or they can hold it if they want. The last example I'll give is ride sharing. So next time you get into an Uber or a Lyft, ask the driver what they think of Uber or Lyft, and you'll get an earful. They take 40%. Well, it's just an algorithm. And essentially, we already have companies that are in this space doing essentially decentralized ride sharing. And this is actually a good point to emphasize that I'm not talking about 100% decentralized. There's certain things that are more efficiently done in a centralized way. And the ride-sharing example is a good one because the certification of the drivers, the safety of the car, those probably are centralized functions. So there will be players in this market that are centralized, that will have a very good business model. So it's not 40% to 0%, maybe it's 40% is reduced to 5%, but you get the idea. Okay, so let me close, and I think hopefully you're getting the idea here. I haven't really mentioned any existing names, but sometimes I go to large institutional investors, and sometimes they say, well, we don't want to get in this crypto space. We don't like it. It's too complex, too volatile. We have zero exposure. And I say to them, well, you might have zero investment in the crypto space, but your exposure is not zero. And there's a slide that I like to share. So I put this up and argue that they actually have negative exposure. And the next slide actually provides the names in terms of this negative exposure. And that's kind of obvious from what I've been saying. So all of these firms, to some degree, are at risk. And this is kind of below the radar screen for many investors. So they don't see the implications of decentralized finance and Web3 on the existing players. Okay, so I'll take some questions now. Okay, we can, let's see. Okay, so the question from Robert, who's a Fuqua alum and a private investor, basically asks that almost all crypto trades are currently done with the central counterparty. Is that not true? So again, there are two types of trading that goes on. So one is centralized exchange. And an example of that would be you set up an account with Coinbase. Coinbase is a US firm that is actually a public firm. And it's regulated, and they've got an exchange that's centralized. And you could send your money there and buy your crypto and trade it on Coinbase, and that is a centralized exchange. So that's one option. Another option would be to go offshore and trade with FTX, and that would have been a mistake. So that was not regulated and offshore. So, and we know the trouble that they got in. So that's one option. The other option is to do trading with a decentralized protocol. And in my class, the very first lecture, we actually did a trade. So I loaded up, I went to, it's called Uniswap, and I've got a wallet that has got some crypto in it. And all of my students have wallets. And then you go to the protocol and it says connect wallet. And you connect your wallet. So that is Web3 right there. So Web3, there's no usernames or passwords. You connect your wallet. And your wallet has got your private key, or this very, very long, complex number. It's the ultimate secure password with 256 bits. So when you connect, you're ready to go. So if you think about setting up an account with a centralized exchange broker like Coinbase, you set the account up, you need to transfer money. And that could take 2 to 5 days. So when I go to a decentralized protocol, I connect my wallet, I'm ready to go within seconds. And what we did in class is that almost identical to what I described. I sent asset B and I bought asset A, and everything was settled in 12 seconds. Okay, and the academic research shows that the cost of trading on these decentralized exchange platforms is actually lower than the centralized platforms for very liquid tokens. So you are correct that most of the trading today is done on a centralized exchange, but the decentralized exchanges are doing a non-trivial amount of trading, and the interest in these exchanges has gone up dramatically. So for example, Uniswap, I just mentioned, has done over $1 trillion of trading. Okay, so that's non-trivial. And the decentralized exchanges have basically shown growth, especially after this FTX scandal. So good question. Okay, so I've got a question from Jimmy, who's an alum, and mentions that he saw my CNBC appearance yesterday, and is what companies do you see leading in the Web3 space? So I'm more than willing to share my slide deck that I go through each of these different uh, parts of existing industry, social media, video streaming, music streaming, and all that. And you will see that there's hundreds of companies in the space. And these companies are not just based in the US. Some of this is from other countries that actually, for example, the decentralized ride sharing, there's many companies operating in India very successfully doing this. So there's a long list. And I'm not going to go through this list. Almost all of it is private equity. So very few companies that are public. And this is actually one of the great things about decentralized finance, that people can often get exposure to the idea by just buying a token. So you start your decentralized Wi-Fi, and actually there's even decentralized mobile communications, which is kind of logical. If you've got the Wi-Fi network, you can do decentralized mobile. So anybody can just go in and buy the platform token, and if it's successful, it'll go up in value. So you get to access the private equity in a way. And the other thing that's very exciting to me is the idea of tokenization. So this means, in my opinion, it's just a matter of time before all stocks, all bonds are tokenized. And indeed, this is not just my opinion, but prominent thought leaders like Larry Fink of BlackRock has already publicly stated that he thinks tokenization is a really big deal. But if we think a little deeper, well, and this is actually not that well known, that if you look at the value of all the publicly traded stocks, that is about the same value as all of the equity that's not publicly traded, that's private. So tokenization gives us the opportunity to, in the future, tokenize the private equity. So in finance, we always say you should own the market portfolio. Well, you can only access half. And if you're a very qualified or rich investor, maybe you can get some access to some of the private equity, but it's difficult. So in the future, all of this will be tokenized. Okay, so let me take a look at. I think we have time for one more question, and let's see here. So this is from Adam. So this is all true, but right now, much of the activity in DeFi is still degen activity that doesn't have much linkage to the real world assets or financial activity. What do you think it's going to take for that linkage between real world and DeFi to finally start to happen in a meaningful way? So that's a great question. So this is similar to another question, and basically, this idea is a new idea. We are like 1% into this disruption. So it's really very early. And if you look at it and say, well, 1 trillion on Uniswap, that's not trivial, but it's multiple trillions trading in centralized exchange. And you're correct that most of the activity is just between different DeFi tokens. And we're not quite there yet on the Web3 stuff. So the way I look at it is that this is an extraordinary situation where this is like a once in a generation type of situation where you've got something that's strongly disruptive and you're at the beginning. And don't judge the size of the disruption by the size of the current market. By construction, if you're just at the 1% point of the disruption, it's going to be small by definition. And what you need to do as an investor, especially, is to think, well, this DeFi space is small, So it's nothing. It's going nowhere. No, that's a myth. That's the wrong way to look at it. You say, yes, it's small now, but the vector is very steep and positive, and it could be really important in the future. Yes, there are risks, and there's going to be more risks realized in the future. But with any new idea, there's risk. Okay, if you don't want risk, invest in treasury bills. So again, this is a situation that to me is very exciting because it deals with my expertise in finance and completely changing the rule book, completely not renovating our financial system, but potentially rebuilding it from the bottom up. Okay, so I'm at my my limit. I'm about to be kicked off, but again, you can contact us, and I do have like a slide deck for this, and it's got many more references and much more detail. 20 minutes is not enough to do what I do in 26 hours at Fuqua. So please stay connected, and I'm glad the LinkedIn Live is up again. I think the next one is March 1st, and hopefully I'll see you there.